Welcome back. You're watching First Trades live on ET. Now, straight off, let me now bring on board Peter Elston. He represents Aberdeen Asset Management. Peter, good to have you back on ET now. Thank you for joining us. Peter, as a house, Aberdeen Asset Management is a long-term bull when it comes to Indian equities. But given the way how things have moved for India in the last 2 years, is your view now changing?
Yes, you're right. We've been a long-term bull on India. I think to be more specific, we've been able to find a large number of Indian companies that we have a great deal of confidence in. So it's not necessarily about being bullish on India. It's about being bullish on these selected Indian companies. And there is a difference in that. You know, in the case of India, you have a lot of challenges at the macro level. There's the need for a number of structural reforms. Right now, we're noticing that you know, the economic performance is starting to become quite challenged. But in that sort of environment, you can still find companies that are able to still thrive and prosper, and that's really what our view continues to be. That you know, Indian companies, the ones that we hold, will continue to do very well.
Peter, I'm sure you can't say that for Bharti. I know you like Bharti, you own Bharti, but you can't say that Bharti as a company will do well in the near term.
No, absolutely, and you know, you're right. We don't get all of our decisions correct. You know, we would hope, I would guess, to get maybe 6 or 7 of our decisions correct. I think in the case of Bharti, you know, we underestimated the extent to which domestic competition would hurt their profit margins. I think our view remains that once we get the consolidation in the industry, which is obviously extremely necessary, that Bharti will be one of the few players left standing, and it'll be a while before we get to that point. But when we do, you know, Bharti will be an extremely good investment. But in the meantime, as you say, it remains a sector where the companies are you know, being seriously damaged by what's going on at a sector level.
So, Peter, are you reducing your position or completely exiting Bharti then?
No, we're not exiting it. You know, we think that at these levels the stock is good value. That has no bearing really on how the stock is going to perform in the near term. But it certainly, you know, represents good value on a long-term basis, and for that reason we're continuing to you know, maintain our position in the stock.
Peter, what about the IT pack? Considering you're interested in the Indian IT space as well, there seems to be some renewed interest in the IT pack as well on account of the valuations that some of these stocks are quoting at. What is it that you like out of the basket?
Yeah, well, the Indian IT sector is one again that, and this applies to most sectors. We've held positions in sectors that have remained, you know, really pretty stable over the last few years. So you know, things don't tend to change that much. With the Indian IT sector, that's one where, you know, we believe India has an extremely strong competitive advantage, but the challenge that it's been facing is that its customers are you know, facing significant problems, meaning that you know, companies in the West are facing weak demand in their home markets, and that's causing them to cut back on IT spending, and the result of that is that the Indian IT companies have been suffering. So the challenges for these companies is not necessarily at a stock level, if you like. It's more at the top line level. Now, we've had some significant depreciation in the Indian rupee. That's made these companies much more competitive than they were. That's a plus. At the same time, I suspect that economic performance in their customer markets is going to remain fairly weak. So net, I think it's going to remain a slightly difficult sector in the short to medium term. But longer term, these competitive advantages that the companies enjoy remain very much firmly in place, and that's what's going to drive the share prices.
Peter, last time I interacted with you was on 15th of June in your Singapore office, and that time your view was that Indian consumer companies are great companies, but these are expensive stocks to own. Have you changed your opinion on Indian consumer names?
Not at all. I think that's exactly what we'd continue to say. You look at the price to earnings ratio of our India fund, and it's around 19 times, and that compares with the PE for the MSCI India index of around, well, closer to 13 times. That's based on 2012 earnings. And the reason why the PE for our fund is so much higher is because of the consumer stocks that we have. The likes of Nestle India, Hindustan Unilever. You're talking 20, 30, 40 times for this sector, which is steep. That said, if you were to extrapolate the sort of growth that we would expect from an emerging economy like India 15, 20, 25 years forward, then you could argue that actually 30 times, 40 times is not expensive, but it's arguably cheap, and
right.
Perhaps these stocks should be trading on 60, 70 times earnings. So it depends which way you're looking at it, but right now I suspect that it's going to be hard for them to advance that much given their valuations.
Peter, let me ask a direct question to someone who is indeed one of the biggest institutional investors in India. If rating agencies, they downgrade India because of the kind of fiscal mess India is in, will that change your India outlook? Will you change your portfolio strategy drastically? And are you also worried their clients who are investing currently with you, they may start withdrawing money?
Well, that's a very good question. I mean, our view has always been that India has great companies that have always managed to find a way to sort of get around the fact that India's politics are frankly a bit of a mess. I suppose that was all fine whilst India's economic growth was still chugging along at 6, 7, 8%, as it had been until fairly recently. The problem now, of course, is that India's GDP growth has really started to slip quite badly. We're noticing that India has slipped down the rankings with respect to foreign direct investment, and you have these structural problems relating to high inflation. And what that is telling you is that India has got these structural problems that need fixing, and there's no real sign at the moment that the necessary actions are being taken. Although the PM has taken on the role of finance minister, we've yet to see any indication that that's making any difference at all. As I said to you when we last met, we think that we do need some sort of series of reforms like the ones we had in 1991, but I suspect that to get those reforms actually happening, you're going to have to see India enter a really sort of fairly nasty period of crisis, and that's what's going to get people off their backsides and supportive of the necessary reforms.
Peter, delight to have you back on ET Now, and we certainly hope to see more of you going forward.